$65 billion gone. Not in a market crash, not in a rogue trade, but in the quiet ledger of one man. Here is the unsettling question. If a neighbor, a philanthropist, a former market leader promised you steady gains in stormy times, would you hand over your savings? The result became a record private fraud in modern finance. You will see how trust was engineered, how fear nudged greed, and how the numbers never added up. Imagine a statement with smooth monthly profit while the world burns red. Would you ask why? Or would relief silence doubt? And here's the twist. The math that soothed investors could never be done in the real market. Follow the names, the checks, the tiny audit firm, and the missing trades, and you will see the trap close. Now, Bernie Madoff rose as a respected figure on Wall Street. He ran a broker-dealer that matched orders for large firms and built fast systems to pair buyers and sellers. A market maker stands ready to buy or sell and earns a small spread, which brought him influence and a reputation for smooth execution. He led the NASDAQ market in the early 1990s, adding aura and access. Over time, he offered a private investment advisory business next to his legitimate trading arm. Advisory means you give money to a manager who allocates assets for you. Investors were told about a split-strike conversion strategy. That means you buy large stable stocks, sell call options for income, and buy put options for protection. Statements showed small monthly profits and barely any volatility. Many investors did not come in directly. Feeder funds did the gathering. A feeder fund is a fund that raises money from many clients and sends that pool to a single manager. Networks in the United States and in Europe sent vast sums, and community ties amplified trust. Access felt scarce, which raised desire and lowered scrutiny. Meanwhile, the audit was done by a small practice in a suburban office. An auditor checks records and confirms that assets exist and trades happened. Here the firm was tiny and the mandate vast, which implied a control risk. Regulators were present yet fragmented. The United States Securities and Exchange Commission examined pieces through limited reviews, while the Financial Industry Regulatory Authority oversaw broker-dealer rules. Investors heard that large banks acted as custodians, which should mean assets were secure. A custodian is a trusted firm that holds assets and confirms their location. Then a stubborn voice kept asking questions. A quantitative analyst named Harry Markopolos studied the returns and said they were mathematically impossible as reported. He sent memos to the United States Securities and Exchange Commission with tests they could run. Yet years passed without a decisive action. By the time the great financial crisis arrived in 2008, fear spiked and redemptions surged. When cash calls rose, the machine showed its gears. The next part reveals how the promised strategy never existed at scale and how the illusion was planted for years. Here is how the machine actually worked. The advisory business did not execute the split-strike conversion as advertised. Instead of buying and hedging stocks in the real market, the team produced statements that showed perfect fills and tidy risk. A Ponzi scheme pays old investors with new investors' money. There is no true profit engine. The illusion depends on constant inflow and managed outflow. Inside the office, a small group ran a closed loop. The supposed trades for the advisory accounts did not route to the exchanges at scale. A back office normally records trades, reconciles with a custodian, and issues statements. Here, the back office became the heart of the fraud. Prices were picked after the fact. That is called look-back trading. You select numbers that would have worked, then claim you got them. Monthly returns were set just below attention-grabbing levels to look believable. Option positions were listed in sizes that the public market could not absorb. Analysts showed that such volumes would have moved prices on calm days. Independent banks were named as custodians, yet the money largely flowed through a single primary account at a large United States bank. Account receipts funded redemptions and withdrawals. When inflow slowed, redemptions exposed the gap. Paper confirms kept the story organized. Frank Di Pasquale, a longtime lieutenant, later described in court how returns were set and how fake tickets were created. Accounting oversight came from a tiny suburban firm that could not credibly test complex derivatives and multi-year histories. Clients were kept at arm's length from the trading process. Site visits saw process binders and a culture of secrecy that many mistook for an edge. Feeder funds delivered pools of money and took fees on both ends. Due diligence was often thin. Due diligence is the process of testing claims with independent checks. It requires seeing trade records at the source. Key steps were skipped. Prime brokers and independent custodians were not truly involved at scale for the advisory business. A prime broker is a large firm that settles trades, provides financing, and verifies positions. Without that control, paper could replace proof. Another lever helped the scheme. Loss aversion makes people fear losses more than gains. Smooth reported gains soothed that fear and encouraged silence. Some who asked questions were told the strategy was too sensitive to disclose. That claim plays on fear of missing out. Meanwhile, the advisory area used jargon and separation that discouraged basic questions. When record-keeping and client-facing sides cannot be cross-checked, fraud risk rises. United Kingdom and United States rules require that customer assets be segregated and verified. The words were on the forms, yet practice failed. The split strike story stayed a story. The dollars funded withdrawals and a lifestyle that projected success. The math did not work in daylight, and the market never saw the trades. The next part shows how the break came and how the truth emerged under pressure. Now that the great financial crisis drained confidence and raised cash needs, fund investors asked for withdrawals at the same time. Liquidity dried up. The advisory business faced redemption requests in the many billions with no matching assets to sell. Inside the office, the story met a wall. According to court records, Bernie Madoff told his sons that the advisory business was, in his words, one big lie. On the 11th of December 2008, agents of the Federal Bureau of Investigation arrested him at early morning. The United States Securities and Exchange Commission filed an emergency action and froze assets. An independent trustee was appointed to gather records and pursue recoveries for customers. A trustee is a court-supervised fiduciary who collects assets, unwinds transfers, and distributes funds to victims. Investigators reviewed trade confirmations and bank accounts. They found that the split strike conversion had not been executed in the market as claimed. Options volumes cited in statements did not match public market capacity. Payment flows showed circular patterns in which new deposits funded old withdrawals. Internal testimony described how numbers were chosen and how paper was produced to fit those numbers. Harry Markopolos' warnings gained attention. He had shown that the return pattern did not line up with volatility and with the cost of hedging. Large banks examined exposure and asked whether the advisory business held the accounts customers believed. A major bank raised concerns in filings after it could not verify advisory trading activity. Feeder funds faced angry clients, board reviews, and regulatory questions in the United States and in Europe. Some funds suspended withdrawals to prevent a run. Families saw retirement plans and scholarship funds shrink. In March 2009, Bernie Madoff pleaded guilty in a United States federal court to multiple counts, including securities fraud and money laundering. He later received a sentence of 150 years in prison. The collapse made one truth clear. When returns looked too smooth for too long, and when questions meet secrecy instead of evidence, time becomes the final auditor. The next part examines the damage, the recoveries, and the lessons for anyone who places trust in finance. Recovery did not end with the arrest. The court-appointed trustee traced money through banks and intermediaries and filed clawback actions. A clawback action seeks to recover withdrawals that were not tied to real profits, so victims can be repaid more fairly. Settlements with feeder funds and service providers created large pools for distribution. By the middle of the next decade, recoveries for customers reached many billions of dollars, a record for a case of this kind. Courts approved distributions that restored a large share of approved claims on a net equity basis. Net equity means cash in minus cash out, rather than unreal statements. Some investors who withdrew more than they put in faced demands to return a portion, subject to law and to good faith defenses. Regulators also changed. The United States Securities and Exchange Commission strengthened examinations, updated custody rules, and revised how tips are handled. Due diligence teams now ask for trade data at the source and for live demonstrations of execution. Risk officers distrust smooth returns that never wobble during stress. That is a warning sign. Bernard Madoff stayed in federal custody for the rest of his life and died in 2021. The human damage ran deeper than balances. Trust was broken. The trustee, Irving Picard, led the recovery effort under court supervision and published regular reports on progress and distributions. Now, here is a compact checklist: trust process over personality. Ask who holds the assets and verify with that holder yourself. Demand external trade data and a live execution demo. If the answer is no, walk away. Require an independent auditor of credible size. Test stories with basic math. Could the strategy scale at those volumes? And would a prime broker clear it? Expect returns to wobble when markets wobble. If results are always smooth, ask why. Incentives drive behavior, so assume salespeople believe their own pitch. Rules help, yet they are not your only shield. Imagine your retirement fund or a scholarship for your child. For more investigations, subscribe to Money Mystery, share this video, and comment with the next case. Be skeptical right now.